Good evening, everybody. Welcome again to another session of the Endowus Access live webinars. Really excited to conclude a three-part series that we've been doing on income portfolios. First one 2 weeks ago was on the launch of the Endowus Income Portfolios. We did a session with our fund management partners on fixed income topics last week. And finally, to conclude, we have four amazing speakers who have joined us. Alex from Jpmorgan Investment Management, Ben from Aberdeen, Lucy from BlackRock, and Lisa from First Sentier, who's joining us to discuss the equities asset class and how dividend investing can be done well. I'm also joined again by my colleague Yulin from the Investment Office. I'm gonna just go through again a lot of disclaimers. When you have 5 licensed entities joining a webinar, this is the first thing that we go through, the fun details. So please bear with us as we go through these important risk warnings and disclaimers for us. And then housekeeping again, we use Slido polls, so questionnaires. So just go into the link here, punch in the numbers, and then you're ready to go. We'll have questions there. You can upvote the questions or I don't think you can downvote. You can upvote the questions. So the most popular questions will be dealt with first by Yulin and I when we moderate the Q&A session at the end of the webinar today. If you're joining us on YouTube, the links are below for all the details, Facebook and LinkedIn as well. So thank you for joining us again today. Just very quickly, an introduction on Endowus. Endowus is a fee-only digital wealth platform. We're famous for being the first and only digital advisor for CPF investing here in Singapore. So the only digital wealth platform that manages both your private wealth and your public pensions. So we're backed by multiple strategic and venture investors and have won numerous awards, but a seamless app that manages all of your wealth here in Singapore. We just launched the income portfolios, which joins our core portfolios of flagship ESG, sustainable portfolios, multiple satellite portfolios, and cash smart solutions. And the income portfolios, if we just do a very quick introduction, we really listen to our customers and investors who have wanted a slightly differentiated income portfolio. Some of the most important things that they highlighted to us was obviously preserving principal investment while receiving passive income distributions. Because many products, especially here in Singapore, sold by insurance companies, dip into the capital of the investment. And so effectively, you're putting in money and paying yourself. So I think that's been a big bane for many investors. And so we've tried to avoid that. Lower fees, targeting both yield, and some people want capital appreciation built into the portfolios as well. And most importantly, flexibility, because a lot of annuities and insurance-linked products are locked up and heavy penalties exist for people that take out the money early. Yulin's going to explain a little bit more on how we built the income portfolios.
Yes, thank you. So we are very excited to introduce this tailor-made income portfolio after listening to our customers, and it really offers the flexibility of choosing the balance between payout or capital preservation or appreciation, and it uses an all-weather approach by combining different funds together from different markets, taking different investment approaches. And we have some of the fund managers here with us, and the fund really leverages the expertise of the best in-class fund managers and their funds to generate income over different market cycles. And as Sam mentioned, actually all our products, we really emphasize providing low and fair fees for all of you by either offering institutional share class access or rebating trailer fees 100% back to our clients. And finally, there is no lockups at all for all our products, so you can redeem and purchase at any time. So moving on, we have launched 3 different portfolios. And the first one is stable income, and that is designed with people nearing retirement or planning for retirement. And it focuses on stability, and the target payout is about 4 to 5%. And it's a great portfolio for those who are looking for just consistent and stable payout month to month. And second portfolio is higher income. So this is designed with the sandwich generation in mind, who have higher current liabilities, but also have a need to grow their wealth over time because they're slightly younger. So this portfolio targets 5 to 6% payout currently, and it also aims to provide a little bit of capital appreciation over the long term. And lastly, the portfolio is future income. So this is designed with a younger generation in mind. So it has a lower target payout of 3 to 4% to cover maybe slightly lighter income needs, but it has a dual objective. So this target payout is complemented with a higher target capital growth over time.
And we built a portfolio with a multi-manager approach. So we work with some of the world's leading fund managers who are our partners in building the portfolios for the income products. Obviously, the Investment Office has curated and screened for hundreds of funds and have chosen the best-in-class products to build the portfolios with. And so we're really excited to have 4 of them with us today: Aberdeen, BlackRock, First Sentier, and Jpmorgan Investment Management, who have joined us. So without further ado, we'll jump in. But the final slide before we do jump in is how low and transparent the fees are with Endowus. So rather than trying to build it yourself, we access the institutional share class or 100% rebate the trailer fees that are built in, the loaded fees that are built into the fund. So the total cost saving is quite significant for especially retail investors who do not have access to these underlying products. So with that, I'm going to ask very kindly and humbly the 4 partners to maybe take the opportunity to introduce themselves as a speaker and then also introduce their firms and their capabilities in the investing strategies. So we're going to go in alphabetical order. I intentionally put that in there so there's no misunderstanding on any favoritism here. So Ben from Aberdeen, why don't we kick off with you?
Thanks, Sam. And Aardvark management couldn't turn up, so Aberdeen gets to go first. I'm Ben Sheehan, a senior investment specialist here at Equities at Aberdeen. I joined Aberdeen in 2019. It's my 3rd anniversary this week, actually. My job is to talk to clients about our equity investment strategies, and I also help to steer the equity commercial strategy in the Asia Pacific region. Aberdeen, as you can see on screen, has a wide variety of investment strategies across public and private markets. Our assets under management total $631 billion, including $171 billion in active equities. We have 1,000 investment professionals looking after all that money. Now, many of you will be familiar with Aberdeen's Asian and emerging market fund franchise that has quite a profile in Singapore. Our regional head office is also in Singapore and was set up in 1992 and was the first of many in the region. Next slide. We have a large equity research footprint, which you can see on screen. This includes 120 members of our equity team across 13 desks, including 7 in the Asia Pacific. This very large team dispersed across the world covers over 2,000 stocks and maintains buy ratings on 1,100. So when we're putting our equity portfolios together, the portfolio managers have a very broad selection of stocks, including a very attractive income-paying stocks as well. Now, our global equity income strategy, Global Dynamic Dividend, or GDD, has a 9-year track record of delivering capital growth and a premium consistent monthly income. And we've recently made this more accessible to clients around the world. It is unique in the market, very differentiated, and it's quite different from traditional dividend funds, and we think very relevant to clients, but I'll share more on this later. Thank you.
Thanks, Ben. Wonderful. And we move on from A to B. BlackRock and Lucy, over to you.
Great, thank you so much. So my name is Lucy Weigel, and I'm a product strategist on BlackRock's fundamental European equity team. And I'm delighted to be here today and talk a little bit about our European income strategy. So we are one of the largest European equity teams in the industry, and that is in terms of team members and in terms of AUM. So we have 21 portfolio managers and research analysts managing over $45 billion in active European products. And the size is really quite important because it allows us to do more company meetings, to do more research, and to look at more stocks in the market. And as a team, we're really lucky to have excellent company access. And that means that we do more than 2,000 every year. And that is just our European equity team. And this helps us to really build conviction from the bottom up. And we believe that we also benefit from the scale of BlackRock because we are able to leverage information from colleagues in different locations, different asset classes, different investment teams. And as active stock pickers, we spend all our time identifying the best global businesses that are listed in Europe. And what we do in this European income flagship product is we look for 3 different objectives that we want to achieve. On the next slide, please. First of all, we look to deliver an above average income. At the moment, the net 12 months trailing dividend yield is 3.4%, which is a significant premium to the benchmark, which has a dividend yield of 2%. Secondly, we aim to provide resilience. So this is a more defensive strategy and typically provides solid downside protection. So particularly in more volatile times, and it does look like we're going to be in more volatile times for a little while, this is a fairly popular strategy. And then the third goal is that we aim to outperform our benchmark. Now, how do we achieve these 3 goals? What we basically do is we structure the fund in 3 different buckets. First of all, we've got roughly half of the portfolio in what we call high yield companies. So these are companies that are well managed, they're good quality companies and very cash generative. And these companies are the types of companies that help us deliver that yield premium to the market. And currently we own a number of insurance companies in here. We own a number of industrials, a number of utilities, and a few telecoms as well in this part of the portfolio. And then the second part of the portfolio, and that's roughly 30%, is invested in steady growth companies. So this is really what we would consider the backbone of the portfolio. These are solid companies, these are reliable businesses, they have defensive income streams and resilient end markets. And these are the types of companies that help us provide that resilience, especially when times are more volatile. And companies that typically meet the characteristics tend to be found in the healthcare or in the consumer staples area. And then the final 20% of the fund is invested in what we consider unique franchises. So here we've got world-class businesses that have strong growth prospects. Typically, these companies have a lower current yield, but they have a very strong dividend growth and capital growth potential. And here, for example, we've got a number of our luxury brands or a number of our semiconductor companies. And I'm going to hand back over to Sam for now.
Okay, wonderful. Thank you, Lucy. And obviously, BlackRock being the largest fund manager in the world needs no introduction, but thank you for delving into your strategies in a bit more detail. We're going to hand over to Lisa and First Sentier next.
Hi, good evening, everyone. My name is Lisa and I represent the intermediary business team at First Sentier Investors. We were previously known as First State Investments, and some of you may have known us then. We are a global asset management firm. We are focused on providing clients with solutions that are high quality and long-term in nature. And while we have a brand name change, we want to assure you that there's absolutely no change to the investment approach that we have. As a firm, we are stewards of $182 billion across a range of asset classes for institutional as well as retail investors globally. And our firm is home to investment teams such as the FSSA investment managers, steward investors, real index. And the assurance that we have is whether it's an in-house team or it's individually branded, each of these investment teams operate with complete investment autonomy according to their own investment principles with solutions centered around responsible investments for our clients. So on the next slide, one of the teams that run our portfolio for our Asian large cap investment strategy with our income feature is managed by FSSA investment managers. This team is led by Michael Stapleton and Martin Lau. So Martin is the lead portfolio manager of that strategy, and he's run it since inception with respectable performance over various time periods. As a team, we have a team of about 20 investment specialists based across Singapore, Hong Kong, and Edinburgh, with investment strategies that they manage across regional single countries, across a range of small, mid, and large cap. So I think a couple of things that will be more interesting to note about this investment team is, number one, everybody on this investment team is an analyst first and foremost. Portfolio management responsibility is it's only a management responsibility which some team members have. Also, it's important to note that the portfolio manager ultimately decides what goes into the portfolio. The second point to note is everybody's a generalist. So some spend more time looking into various countries like India, but they would also allocate time to look into other markets and sectors. It gives them an unbiased view, which will be able for them to bring more ideas to the table. So I give an example. An analyst who covered an India bank, he will know how that bank compares to a Singapore bank, a Japanese bank, a Chinese bank. And ultimately, that gives him a better perspective of what could have gone right or what can possibly go wrong with that company. More importantly, one of the competitive edge against our peers is that all the team members have a significant portion of their own wealth invested into the team funds. So they invest their monies as if it's their own, and their co-investment reinforces this belief. Not only do they wish to be aligned with our clients, they also cannot think of a better way for them to invest their retirement monies. And I think that this is the mindset which we have to allow us to achieve superior investment returns for our clients in the longer term. So I'll just quickly distill down the investment approach for this investment here on the next slide. We focus a lot on generating absolute returns. Sorry, next slide, please. Yeah, thank you. So we focus a lot on generating absolute returns for our clients, and capital preservation is key to us. And with every investment that we make, we always consider the downside, not just the upside. In our view, the benchmark is irrelevant in the investment process, as many of these companies are not quality enough for us to invest into. And as benchmark investors, we tend not to get, we tend not to forecast how the market's movement so as not to get carried away by market noise. Essentially, what we're really aiming to do is to embed the portfolio with the highest quality companies, with the highest competent management team, those that can grow earnings at a sensible and grow their earnings sensibly and investing at them at a sensible price. Also, as a team, we integrate ESG analysis within our investment process since inception of this investment team back in 1988. So it's not a new team that we are talking about as well. More importantly for us, one of the litmus tests that the investment team has is in the event markets drop by 20-30%, will they panic and sell off the investments that they have bought into, or are they going to buy more in such periods? Now, with the investment response is that I'm going to panic and sell, then it reflects that you should have never invested in a company in the first place, and you don't have a very high conviction of that company that you have bought. Hence, our turnover for our portfolios tend to be quite low. It's around 20%, and these are mostly trims and additions, not wholesale turnover of the names altogether. So we are truly long-term as an investment team, and I'll hand over the mic back to Sam. Thank you.
Great. And last but not least, Alex from Jpmorgan Investment Management.
Thank you very much. Now, do you know that Sam and I have known each other for over 20 years? And do you know what else? He hasn't aged, and I now look like his uncle, and that isn't fair. Now, on to Jpmorgan Asset Management. So like everyone else, we are big. We're very, very big. And the slide you have in front of you is just our emerging market and Asia Pacific franchise. So we have about 100 investment professionals. We invest just under $200 billion on behalf of our clients. You can see from the bottom that we have a full array of strategies across our different investment centers, and we've been doing this for over 50 years. So this is our bread and butter. Now, if we go on to the next slide, please. At the center of this, the core of this is our research platform. Because you can't do good in-depth investing, as my colleagues and competitors have said already today, without having the right team of analysts. And this is what our analysts look like. We don't recruit our analysts based on their physical appearance. We recruit them based on their expertise and their intellect. But you can see that it is a very wide, well-resourced and diverse team of people. They speak something like 17 languages between them, and they are really, really good at feeding ideas into our different portfolios. And the portfolio, or the strategy I'm here to talk about today, is emerging markets dividend. It's on the next slide, please. And although we've got lots of words here, there's just a couple of things I want to bring your attention to. The first is that we are also long-term investors. And we think that our clients enjoy income. They like clipping tickets. They appreciate the money coming to their account. They like the lower volatility that gives them within the asset class, but they also want growth at the same time. So investing in high yielding stocks gives you a higher quality approach, because companies which pay dividends are typically thinking about what their investors want. We believe that dividends are a good proxy for corporate governance. And we think that within emerging markets, although some people reflexively just think about EM in growth terms, actually combining income and growth has been a really good driver of total returns over time. And that team of analysts that I showed you on the previous slide, they keep on giving us the ideas to keep exploiting this. So why don't I hand back to Sam or to the other speakers, and we can explore this in a bit more detail.
Wonderful, Alex, and it's so always great to see you after 20 years. But to be honest, you did look like my uncle back 20 years ago as well. Yeah, we know that our clients are not so superficial. They're not into looks. They really value your intellect and your insights. So I'm going to hand over to Yulin to moderate the next section for us. Thank you.
Yeah, thank you. Yeah, it's really exciting to have like such experienced investors here with us. And I am sure that all of our audience cannot wait to hear your thoughts on the market. So let's just jump into that. And actually, Alex, I'm gonna hand back over to you to talk about the macro environment now.
Happy to, delighted to. So if we see the column from the second right, this is where we think we are in the macro environment right now. So starting a couple of years ago, we all got hit by this calamity, which was COVID, which remains a calamity in parts of the world. And that, of course, that caused a very, very rapid contraction of economic activity, as you all know. Now, the world recovered relatively quickly from that. I think the global supply chain did an extremely good job of adjusting to those difficult circumstances. And the fact that we can all speak to you from many, many different locations, all via the miracle of modern technology, is part of that. And so that took us into an early growth cycle. And we think we are now beyond that. So we're mid-cycle. And what this means is that growth rates are robust. Inflation is rising, as you will all be aware. We don't need much in the way of fiscal stimulus anymore. And what that means for income investing is that the higher earnings will feed through into higher dividends. So this is something which is quite important for companies which maintain a stable payout rate or a growing payout rate. As the economy recovers and earnings recover with that, then the dividends you will receive will increase too. Now, late cycle we think is still some time away, but at the moment we're in a sort of quite a happy spot for equities because we've got this growth and it's feeding through into the returns that we can feel in our portfolios. Now, there's one other thing I'd like to address on the next slide, please, which is fiscal and monetary stimulus. And there's a lot of colors and lines here, but I think the key takeaway from this slide is that if things go backwards, if we have an accident, actually emerging markets are quite well positioned to benefit from that. The reason being that unlike previous cycles where maybe emerging market governments and central banks were leading the way in expanding their balance sheets and cutting interest rates, actually emerging market central banks have been remarkably restrained compared to their developed Western counterparts. So we think there is firepower. We think the economy is recovering. We think that things are fine. But if we take a step backwards, there's some dry powder in case.
Great.
And I will hand back to you now. Thank you.
Yeah, thank you. That's a very, very useful overview on the emerging markets as well as the US, as you briefly mentioned. So how about Europe? And I think Lucy, BlackRock has the Europe Fund. So can you just talk us through about Europe now, as you know, it's facing a lot of problems as well?
Sure, thank you very much. So we do think that we are in quite a unique environment at the moment. And if we think about what's happened in the last couple of years, well, in 2013, for example, we had that taper tantrum where the Federal Reserve in the US was slowly putting the brakes on its quantitative easing measures. Markets were worried, but actually what we saw was that equity markets didn't hugely derate. And then in 2018, that was definitely a fairly volatile year with rate hikes in the US, and we saw several rotations in the European equity markets where value assets sharply outperformed growth assets for shorter periods of times. And that is something similar to what we're seeing at the moment and what we've seen over the last couple of weeks. And then 2020, and we just touched on that before, of course, saw a very quick restart of the economy. And importantly, in Europe, for the first time in many, many years, we started to see fiscal policy after Europeans had previously mainly used monetary policies to face a crisis. So over the last couple of weeks, really since the start of this year, we have seen some incredible moves in European markets focused on growth versus value. And this is, of course, on the back of central banks' intentions to increase rates, particularly in the US, to fight higher inflation numbers. Now, ultimately, we think that most inflationary pressures are likely to normalize, even though it is taking a lot longer than most people, including ourselves, expected. But many of the inflationary factors that we are seeing at the moment are still dependent on COVID-related actions that, of course, continue to impact supply chains, logistics, etc. But a lot of these higher prices, for example, in the auto sector, are likely to normalize as and when supply chains normalize. And on this slide, that's perfect, thank you. You can see a supply chain heat map, and towards the right-hand side, it is very clear that supply chains still remain under a lot of stress. One inflationary factor that we don't think will normalize as quickly are energy prices. And the bottom chart shows that electricity, gas, oil prices in Europe have all gone up significantly recently. And we think we've, over the last couple of years, been quite skeptical about energy companies in Europe for this portfolio, because they need to transition their business models away from oil and gas and towards renewables, which A, will take a lot of time, and B, returns just tend to be slightly lower in that area. But over the last decade, we have seen the energy sector, been quite underinvested for quite a long time. And now we are seeing a very fast restart of the economy. And that means that we might be entering a period of higher oil prices for longer. So that is an inflationary pressure that we think can sustain for longer. And in this portfolio, we are still underweight energy, but we are actively looking for opportunities to benefit from higher oil prices across different industries, even if that is not, through investing in European oil majors itself. And then importantly, just to point out, we haven't dramatically changed our portfolio over the last rotation that we've seen over the last couple of weeks, because our fundamental outlook for the market and the companies we own in this portfolio isn't that different now to what it was back in December. And I'm just going to hand back over with this.
Great, thank you, Lucy, and also Alex for that wonderful macro backdrop. I think obviously it's a very important time to assess macro with a lot of policies affecting where markets will be headed. But it's also good to maybe do a quick review of the markets and before we do some outlook views in 2022. So I'm going to hand over to Lisa from First Entier to discuss some equities market outlook for this year.
Thank you. It's always good to look back at challenging periods, how the index has performed in various time periods of such like 2013, 2018, 2020, 2021. What's more relevant to you as an investor is how we've managed to navigate the portfolio through with stronger downside protection. So I think you look back in 2013, a lot of talks were around US strengthening, QE tapering, and that triggered corrections in emerging markets. At that point of time, investors were focused on increased leverage in Asia and the current account deficits experienced by some of these Asian countries. So if you take a look at countries like Indonesia, India, Thailand, they all detracted versus some of the other players in the index. Now, if you look at our portfolios today, we actually have a large allocation towards India, approximately 1/5 of the portfolio is allocated from a bottom-up perspective due to the opportunity that it presented in 2013. So at that time, investors were fleeing out of India markets. Your rupee fell by more than 20%. Your stock market valuations also fell. Your stock price also fell. As contrarian investors, we took the opportunity, in fact, to add significantly to our portfolios on the back that a lot of these companies, which we wanted to buy earlier on, were trading at high valuations. So in that view, it's a big discount. Long-term quality companies, there's no change to the fundamentals of the business, and share prices are just affected by market sentiments. And over time, this actually proved to be a pretty decent call for us as Indian equities added positively to our portfolio performance. Another year that you would also look at is 2018. So this time around, stock market suffered because of your prospects of US fading policy support. And a lot of stock markets actually had flourished very well because of low interest rates environment and, you know, with the government printing money, so on and so forth. The US-China trade conflict also took another toll on investors' confidence, which we would have quite a fair bit of allocation towards. And if I can turn you to the next slide, that would be perfect. So on the top right-hand chart, you will actually note that there has been historical precedents for the current political climate which we are in. So back in the 1980s, if you look at the US and Japan, back then US levied high tariffs on Japanese car imports, heavily affecting the car industry then. And why I bring that up is because Toyota is a case in point. Today is still one of the industry leaders, but they in fact have shown you that trade war was in fact good for the business in the longer scheme of things. So they use the local resources to support its global expansion, produce cars in the US. So a couple of our thoughts, because the current political climate between US and China still remains. Firstly, it affects market sentiments rather than having a major impact on the economy in China. Secondly, it's important to bear in mind that the Chinese economy is still very much domestically driven. Exports really contributes only about a quarter of the GDP growth. And finally, if you think about it, as global demand recovers, China still remains a reliable manufacturing source for most of the markets around the world. Hence, you know, when you actually have a sell-off because of the higher tariffs, it represents opportunities to add to our holdings of attractive valuations and quality names. Okay, and it's like, you know, if you look forward to the last few years, then came COVID, right, which was clearly a constant in the last couple of years, not just a health crisis, but again led to supply chain disruptions, adjustments in the labor market, and all of these have boosted inflation. Now, when you look back to when it started, the whole world was in a recession, right? We had strict lockdown measures imposed by governments around the world. And there was a period where there was blind faith in the central banks printing and government spending vast amount of money for them, with all asset classes having a good years of returns. Yet, a lot of the equities that were in the markets were undervalued for some of these companies, but investors were willing to focus on growth, focus on certain themes such as technology stocks, as they believe that those were good long-term trends. So what we wanted to do was essentially look beyond the pandemic to try to identify which companies had strong enough balance sheet strength to weather through the pandemic, long-term franchise values that were underappreciated by the markets, and that gave us more confidence to add on during times of market sell-off. And subsequently, again, we saw a 180-degree change in the perceptions in some of the markets like China. And to us, that was a healthy reversal in sentiments. And we actually think that if you look at the risk and opportunity that's present in 2022, we believe the interest rates environment will rise in Asia. The liquidity environment may be less favorable. But a lot of companies also have not yet thought about inflation for a long time. So we've always highlighted about our concerns with regards to that. And the discussions that a lot of them are having now within their cost structures, the working capital. So as liquidity tightens, we do expect that the markets will remain more volatile. Some of the more expensively valued, overcrowded sectors can be vulnerable. As such, we focus on companies with strong cash flow, daily growth, decent dividend yields. In that case, we also do have a meaningful allocation to financials, which will benefit from the rising rates environment. So two large long-term opportunities still remain in Asia from a bottom-up perspective. One is in India, the other is in China. So earlier on, I did mention that the sentiments in China have turned negative. If you actually think about it, in 2022, as some of the uncertainties clears up, there may be opportunities in these areas. The recent RRR cuts and your LPR cuts signals that Beijing is willing to add some cushion to the slowing economy. Valuations also are more attractive at this point of time. As rates start to tighten elsewhere, China may actually look more attractive to global investors, and we've continued to add to names there. As the economy reopens as well, Southeast Asia, which has been heavily impacted and overlooked by some investors, may also have pockets of opportunities there. So I think in short, every crisis does provide opportunities for you as an investor and for companies alike. And more importantly, as bottom-up investors, we like to see how these companies navigate through the crisis, as higher quality companies usually emerge from them stronger than before. Okay, and then, yep.
Wonderful. Thank you, Lisa, for that great look back at markets also, and identifying the risks and opportunities, especially in Asia. Maybe Alex can go next and provide us with a broader emerging market context.
Yes, I would love to. Thank you. And I've only got, I think, 2 points to make. The first is, isn't it interesting how investors behave? Last year, as Lisa pointed out, was quite a difficult year for emerging market equities and for Asian equities, and people take that really negatively. Now, if you go to the shop and what you want to buy is cheaper, is on discount, you don't leave the shop in a terrible mood thinking everything's just got cheaper, I refuse to shop there. You think, fantastic, I'm picking up a bargain. And that's how I think we need to think about equity markets, which is, don't use the fact that emerging markets have had a tough year as an excuse to run for the hills. Rather, if you can find assets that you like and they are cheaper now than they were previously, well, then you've got yourself a bargain. It's like going down the vegetable aisle and finding everything is cheaper. That's a happy thing to encounter. So let's have a look at the charts we have here. What this is basically saying is that as markets faced headwinds, equities have got cheaper. So valuations are reasonable. And this is really important because although we can find lots of asset classes around the world which have got some quite exciting thematic winds behind them, tailwinds behind them, if they're already overpriced, they're not going to be a good investment proposition. And emerging market valuations are reasonable. So that's the first point I want to make, is I think you should be very enthusiastic about emerging markets. I think we're all living through the Asian century and we can celebrate that. But also always make sure you put a price on it. And the price at the moment looks fine to us. Now, the second point I'd like to make is on the next chart, please. And this kind of reiterates something I said already, which is that we're here to talk about dividends. And this particular set of circumstances we're seeing at the moment is quite positive for dividend investing. As mentioned, the stage of the economic cycle, the recovery that we are enjoying, is positive for equity earnings. That means that companies, or the right companies, will pay out more of those earnings as dividends. And that means as investors in emerging markets, we can benefit from the rising share prices, hopefully, as earnings carry on growing, and the higher dividends they will pay us along the way. And this is very, very important, because companies who pay dividends are typically companies which are looking after their investors, and good corporate governance is important to all of us. So I think those are the key points I want to make about the current market environment.
Great, wonderful. And last but not least, we'd love to hear from Lucy specifically on the European markets as well, and your outlook there.
Brilliant, thank you. So we are constructive on Europe. Europe is, of course, hugely interlinked into the global economy and benefits from the ongoing recovery and economic growth. We see record fiscal spending in Europe, and we think that the region is likely to continue to be fairly supportive in terms of monetary policy as well. And we do think that there are many companies out there and in our portfolio that can continue to create wealth for shareholders. However, we think that over the next 12 months, this is likely to be more volatile than it was over the last year. So over the last year, European markets have been supported by a cyclical rebound, by positive earnings seasons, and supportive policies. Now, in 2022, we think that some of these tailwinds are likely to fade a little bit. So you have tougher comps now, you have some raw material headwinds, and of course, a lot of noise around rising interest rates as well. And if we do go into a period of slower growth, which we do think is a potential, and at the same time, central banks continue to tighten financial conditions, then we do see a risk of a potential policy mistake as well. And of course, all this can create quite a lot of volatility in markets. But for us as active investors, it's of course an opportunity to truly understand the companies and income streams that we are invested in and focus on strong management teams that can navigate these more volatile times. So overall, we still think we are in a robust environment for corporate profits, but there is a risk for a policy mistake and there is a risk of a mid-cycle slowdown. So we want to be very selective in what we own. A few more words specifically on the portfolio, maybe on the next slide, if that's okay. What is really encouraging to see is the ongoing fiscal spending in our region. So in Europe, a lot of the fiscal spending is still to be spent, while in other regions in the world, a lot of the spending, the COVID-related fiscal spending has already been done. And we see some of this fiscal stimulus as very supportive for a number of companies addressing issues like digitization, improvement of energy efficiency in buildings, renewable fuels, or companies that can help enable the shift towards electric vehicles as well. And these are all trends that we think many European companies can benefit from in the years to come. And this strategy is, of course, exposed to these trends through a number of infrastructure or construction companies that can help with the refurbishment of buildings, or our utilities with exposure to renewable energy, or to digitization as well through our semiconductor exposed names. And then just one last word on the next slide, please. There is a valuation point to be made when we talk about Europe. European markets trade at their historic average, and especially compared to US equities, European equities are just a lot cheaper. And I leave it at that. Thank you.
Thank you, Lucy. And it was really refreshing actually to hear Alex comment on the equity market being a bug, and we see that it's probably true for both emerging markets and Europe at the current moment. So I guess let's just move on, and there is another pressing concern on a lot of investors, and that is, inflation and rising rates, and obviously, dividend stocks or dividend funds, they focus on paying a stable income for investors. So what's your actually outlook for specifically dividend investing for 2022? And also, how would inflation and rising rates actually impact the potential, the prospect of receiving consistent payout in the year to come? And I will let Ben from Aberdeen to start us off.
Thanks, Yulin. So the outlook for dividends is positive. The current dividend environment is one characterized by steady recovery and resilience. The global economic recovery has resulted in an earnings recovery, which is, of course, favorable for dividend payouts as well. In the 12 months ending 30th of September 2021, global equity universe paid in excess of $1.2 trillion worth of dividends. That's in aggregate. So that's a terrifically large number to get your head around. So there's plenty of dividend opportunities to take advantage of. So looking at the chart in front of you here, we are plotting the dividends paid by sector, these are global sectors. And overall, we had a 22% increase in dividends paid by companies between the third quarter of 2021 and the third quarter of 2020. So this is a hugely positive backdrop for dividend paying companies. And as you can see, it's quite broad-based. While materials and energy did exceptionally well, if you scale it back, 9 out of 11 GICS sectors, so that they're broad industry sectors we refer to, delivered positive growth for dividends during that period. So not only shows that dividends are strong, but the global economic recovery of earnings and dividends is also very broad-based. Next slide. Looking backwards, dividends have also been a dependable source of income. Here we show the dollar value of dividends paid by companies in the MSCI All Countries World Index. Now, the dependability of dividends was last properly stress tested during the beginning of the pandemic in 2020, which triggered a global recession and a pullback in equity markets. Even during 2020, around $1 trillion of dividends were paid by global equity companies. So that was the last stress test, and I'm happy to say that global equity markets passed with flying colours. Currently, we have cash on balance sheets that are at historic highs, so this provides a positive backdrop for companies to pay dividends. And looking at the cash piles that are available on a sector-by-sector basis, technology, consumer sectors, communication, healthcare, and financials are relatively well placed to generate dividends moving forward. So while it is clear that we have higher rates in the coming year across major economies, with the probable exception of China, who's going the other way, it is important to differentiate between higher rates and high rates. So even if the Fed moves 5 times this year, for example, we will still end the year with interest rates around 1.25%, which is still very low by historical standards. And I think we'll have, I guess, a backdrop which still remains positive potentially for equities. So the earnings outlook for global equities is for double-digit growth, and we expect dividends to continue to grow at a similar rate. But if you are worried about inflation and higher rates, let's consider what happened in the 1970s to equity returns and equity dividends. So in the 1970s, which was a period of high inflation, high interest rates, the S&P 500 returned 77%. Now, of that 77%, 3/4, so that's almost 60%, 3/4 of that total return came from dividends. So this underscores the importance of dividends for total returns, not only as a source of income.
Great, thank you, Ben, for that very, very I guess uplifting comments for the dividend investing outlook. And next up, we will have Lisa from First Sentier. Oh, sorry, Lucy from BlackRock. Sorry.
Perfect, thank you. So first of all, we don't expect meaningful rate hikes in Europe. The ECB, the European Central Bank, hasn't confirmed yet what it is going to do this year, but we don't think that potential rate hikes will be significant. And I would very much echo Ben's comment here that there are higher rates and high rates, and we don't expect high rates, even if they are higher than what we have seen in the past. In terms of dividends, so last year we grew our dividend by 29% after it had fallen by just over 30% in 2020. And 2020 was, of course, a year with an extreme number of dividend cuts and dividend suspensions, mainly COVID related, or very often driven by regulation. And then in 2021, companies played catch up as regulatory pressures on dividends faded, and many industries experienced a strong recovery and were therefore able to pay dividends. And going forward, we would expect modest dividend growth. So we are somewhat cautious of some of the highest dividend paying areas in the market, such as tobacco or commercial real estate or the bank sector, the auto sector, because many of these companies many of these industries are, first of all, quite volatile and also face some severe structural challenges. Instead, we focus on our resilient businesses, many of which pay a very attractive dividend, but in our view, right now is not the right environment to go into those really high yielders in parts of the markets that are structurally challenged. At the same time, we are keen to deliver a sustainable dividend yield, and we do not chase a higher dividend yield number if that risks the resilience and defensiveness of the portfolio. And of course, and I do need to caveat that, a lot of this will to a degree depend on the macro environment we are in. So if we believe we have to move the strategy into slightly more defensive assets, such as lower yielding consumer staples or lower yielding healthcare, that could of course negatively impact dividend growth. But at the same time, a strong economy and value assets moving higher could, of course, lead to a higher than expected dividend growth for the strategy. And while we don't expect huge interest rate hikes in Europe, gradually rising interest rates can be an indication of a strong economy. And that is, of course, supportive of corporate profits, and that could help companies increase or pay a dividend. And in our portfolio, we've got a number of companies and industries such as European insurance companies that could be beneficiaries of higher rates. But at the end of the day, most of our companies should easily be able to operate in an environment with higher rates, because we tend to be invested in higher quality, lower leverage, better capitalized businesses. And as active investors, and that's my final point on that, we always want to come back to the fundamentals of each stock. So you need to ask yourself whether, the company you own will actually be impacted by the US 10-year being at 1.5, 1.7 or 1.9. Does that actually make a difference for the business model? And if you're invested in the market leader in a certain field, then actually it shouldn't make a huge difference. And I hand back over. Thank you.
Thank you. Thank you. So Lisa, would you give us your outlook for the Asian market specifically?
Just quickly, we consider dividend as an important source and component of the investor returns. And looking back at some of our Asian strategies that we have run, dividends have actually accounted for around 20% of the overall portfolio returns over the last decade. But it really just goes beyond just the receipt of income. Dividends payments actually tells us a lot about the health of the company, the underlying resilience, and the persistency of that firm, right? So some of the key characteristics that you want to look out for within the portfolio is for a positive dividend culture. So it's important not just to focus on cash flows, particularly within a rising rate environment, but an example, if you are receiving a plethora of emergency cash calls, that in fact suggests that you could possibly hold on to a lot of cyclical names, lesser quality balance sheets. And as an investor, maybe rather than focusing on high dividend headline numbers, what would be better to think about is from a dividend per share growth perspective. And this is the mandate of the strategy that we have as well, where you want better companies to have the propensity to continue to distribute higher dividends along the way. So you look at companies like Taiwan Semiconductor. This is the world's largest chip manufacturer. Lots of Asian portfolios would have TSMC. It actually has generated very attractive shareholder returns. They have high level of free cash flow. Its dividend per share has also doubled over the last 5 years. So these are the kind of quality names that we would like to own, respective of the market season that we are seeing. And if you can slide on to the next slide, really, this is how you expect our strategies to perform during times of higher inflation. Most of the companies that we have on the portfolio have the ability to pass on inflationary pressures, and they will continue to be key differentiators. As long-term investors, we remain confident about the companies that we have invested into, and we believe that they should outperform in all market cycles, as in they should perform well in all market cycles. So probably just the last slide to have a key takeaway of is on this 3 bars. I mean, if anything you want to take back today, it's really this three bars here. Essentially, in a bullish environment, we will capture most of the market gains. We tend to outperform the markets 43% of the time. But it's a down environment where you expect us to hold on a lot better to the gains that we would have made during those periods. Essentially, in all market environment, we tend to do quite well, lower volatility and better downside capture. Okay, so then the next slide really is just a snapshot of what we own and what we don't own. Since I've joined First Sentier, we've been having this slide for the longest time. Really, it highlights the bottom-up conviction of the investment team. And these are just some of the broader long-term teams that you will see coming in over the year. I'll hand this slide.
Great, thank you, Lisa. Last but not least, Alex from Jpmorgan on emerging markets.
Sure. Well, look, there seems to be some agreement there's inflation in the world. I'll tell you what not to invest in if there's inflation, and that's cash, because it's going to be worth less next year than this year. And someone much more intelligent than me can tell you what happens to fixed income in a rising rate environment. Now, as for emerging market equities, how do we handle this? Why is this an attractive asset class? And the first thing is the old investment adage that the more stones you turn over, the luckier you get. And emerging markets are a gift, because as you can see from this slide, they are diversified by country, by broad region, and they're diversified by sector. And that's really important because it means that whatever's going on, we can find a stock which will benefit from that particular set of circumstances. Now, I know what you're thinking. You're thinking, give me an example, be specific. So let's go to the next slide, and I will give you an example. And this is this great theme of China consumer. We all know the Chinese middle class is expanding rapidly. We know that people have got more money to spend. So what do we do about that? And the dairy industry is maybe not particularly sort of spectacularly exciting, but it's super, super interesting. You've got a consolidating market, which means that the companies in that market will make more money. You've got management teams in the middle of this page who are prioritizing profitability. So they're not taking this beneficial situation and wasting it. They want to make more money, and as equity investors, we will make more money alongside them. And as part of that, they are getting serious about dividends. So, is this going to change if inflation goes up a bit or if inflation goes down a bit? Not really. The corporate fundamentals will override the macro circumstances. Now, you might be thinking, yeah, but I don't invest in emerging markets so that just to buy dairy companies. It's not interesting enough for me. I like this growth stuff. So let's have a look at the next slide. And what is so encouraging about this is that in the new economy, as well as in the old economy, we can find income. So our example here is games. The economics of this industry is improving because smartphones provide a better platform than games than just sitting in front of a terminal somewhere. The duration, which is to say, how long will these companies make money for? Well, that's determined by platform flexibility, which means that people will have a better experience playing computer games. And then, of course, as for all of my competitors, we look for companies who've got good corporate governance. And I think this is just super, super important because you can find dividends in many different emerging market geographies. You can find them in many different industries, and you can find them in many different companies. And I'm relatively rapt about inflation, which is the central question here, because if you find the right business, that's what will actually impact your wealth over the longer run, not the macro backdrop. So, Yulin, back to you.
Wonderful, Alex. I'm going to take over, and we're going to touch upon a theme that Alex just inferred about, which is many people are worried about the fixed income market in a rising rate environment, and how do we compare dividend investing in equities versus fixed income? So I'm going to hand to Lisa first to touch upon the valuation aspects between equities and bonds.
Okay, so if you look at the darker blue line on the charts here, it really indicates the Asian interest rates as well as the US 10-year Treasury yield. Both of them have fallen in the same direction. Of course, it's picked up slightly. It's dangerous for us to assume that the bond yields are going to continue to stay so low. Rising bond yields will definitely have ramifications on equity valuations. That said, we don't believe that the bond yields affects the fundamentals of the businesses that we invest in from a cash flow and a profitability perspective. And in short, we actually believe that equities offer better value for money. So if you consider bond yields from, let's say, one of the holdings like CK Hutchinson Holdings around 2.7%, while the dividend yield for that is around 4+. So in such an environment, it's important to continue to diversify our portfolios, remain defensively positioned. You want to have quality companies that are uncorrelated to the macroeconomic environment and want to retain the risks and opportunities as present. Yeah.
Okay, great. I'm going to go back to Alex to maybe touch upon, what are the unique aspects of equity dividend investing where you balance the income and the growth aspects of dividend investing?
Sure, well, I think you just said it. Now, call me greedy, but I don't just want income, I want growth at the same time. And that's the whole point about equity investing in yield stocks, is that you can get the best of both worlds. No one is, in the emerging market century or the Asian century, what we all want is to participate in the growth that we're seeing around us. And you're not going to get that by buying something whose capital value never changes. So what we do in our portfolio is we try to balance across this. The core of the portfolio, it sits in good, high-quality stocks which are paying a 3 to 6% dividend yield. But we don't just want that. We also want to get some more growth, some more oomph in the portfolio, and that's on the left-hand side of this slide, where around 20% of the portfolio sits in stocks which they still pay a yield. It's a bit lower though, and we're willing to sacrifice some of that yield for the earnings growth they give us. And then to make sure that the overall experience is still got a sufficient payout, we also have some higher yield stocks, and they act as a bit like the foundation of the building. They're super steady, they're not going to grow much, but they give you that really nice income over time, and then we just get the earnings growth on top of it. But for my final slide on the next page, please, it's very, very important to make this point that just because a stock pays a dividend, it doesn't mean it's worth investing in. And I'll give you a couple of compare and contrast examples here, if that's okay. So box top left, we've got a Taiwan integrated circuit producer. My compliance department is a stricter compliance department, so I'm not allowed to tell you the company's name. But I'm sure that my competitors know what I'm talking about. And here is a stock with a 7% yield, 4% growth. It's got 22% ROE, and what that means in basic terms is it's profitable. It's making a lot of money. So it's giving you yield, it's giving you growth, it's profitable. That sounds like a pretty attractive proposition, doesn't it? Conversely, if we take another Taiwanese company which makes displays, maybe like the one that I'm looking at right now, it's got an 8% yield. So there's a big ticket there. But look at the growth number. It's got negative growth. Now, why would you buy something which is going to be worth less next year than this year? That would be a really peculiar decision to make. So we've got two stocks. They're kind of in contiguous industries. They're both in the same market. They've both got fat yields, but one of them is growing and one of them isn't. And that's really what makes our investment decision. And on the bottom half of the page, I've got a different set of examples, in this case from the broader consumer world. So bottom left, there's a Mexican consumer staple stock. The management's aim is to grow the dividend in real terms every year. And for 22 years, they've put their money where their mouth is, and they've been paying dividends. Super important. If someone does what they say they're going to do, that's worth something as an investor. So we like the stock. Conversely, if we take an Indian autos manufacturer, well, the operations are going well, their sales are growing, their profits are growing, and then without a proper explanation, they cut their dividend. That's bad behavior. So that's something that we would avoid. So we've got two stocks which are in interesting areas in Mexican consumer staples, Indian autos. We know Indians are buying more cars. We know that'll make more money over time. But if we can't trust management to look after our interests as yield investors, then we keep our distance. So just because it's got a yield doesn't mean it belongs in an income portfolio.
Wonderful, thank you, Alex. And we're gonna touch upon, a specific fund, just to caveat that by saying that all of the other fund managers, and we have some questions on the Q&A session about specific funds. We cannot answer them on the webinar today, so please reach out to our client advisors or reach out to the fund management companies directly if it's possible. But we are able to talk about Aberdeen's Global Dividend Fund. So Ben, if you can give us a little bit more detail on a specific example of how you manage a dividend fund here.
Yeah, sure. Thanks, Sam. So just an answer to your question around equities versus bonds. Well, you're barely earning 1.5% for investment grade bonds at the moment. And the tightening policy backdrop makes it hard to commit to an allocation to fixed income in the short term. But in terms of the global dynamic dividend strategy, it really is a fund that is suited for the times. It is delivering or aiming to deliver a monthly and premium competitive income that stacks up well versus other yielding asset classes. We do not use covered calls or complex derivatives to deliver on our yield objectives. And something that is quite differentiated from other products in the market in that we look to diversify across growth and value stocks. In fact, 40% of our portfolios is in growth stocks. So if you want to hedge your bets on value versus growth moving forward, this may be the vehicle to consider. Finally, Global Dynamic Dividend, or GDD, invests globally. So we make sure we have access to the best capital growth and income opportunities wherever they are. Next slide. Here we're just sharing with you our track record of consistent monthly income delivery. So we're sharing our share class here, which has been paying 5 cents per month. On an annualized yield basis, you can see that over the last 12 months, that's given a return of somewhere between 5 and 5.5%. So as I mentioned, does stack up quite well. And over to you, Sam.
Okay, wonderful. Actually, I've looked through the questionnaire Q&A questions that are on Slido, and you guys have done such a fantastic job. You've answered pretty much every question that's there. Our client advisors have answered the company-specific questions. The only one that kind of is outstanding is some of these questions about balanced portfolios, 60-40, whether they're still relevant. Also some questions about income portfolios and their performance recently, how they've been negative. And so the backdrop is that I think overall, what drives returns primarily, and what attribution, in terms of attribution, 90% of the returns are driven by asset allocation in a multi-asset portfolio. So equities is down, fixed income is down from an absolute return perspective. And so it's not surprising that even income portfolios, whether they're dividend equities or whether they're fixed income distributing asset classes, it doesn't matter. I think most of them are negative. But the most important thing is that, especially the Endowus income portfolios, but the underlying funds themselves as well, it is all about the long-term income generating aspects. So companies who pay out dividends will consistently pay out dividends. As Alex highlighted, if they're good companies, then with growth, then they'll compound returns over the long term and build wealth for you as well. If it's a fixed income, investment portfolio, then obviously we have some short-term mark-to-market impact as a result of rising interest rates and market yields. But over the long term, if you hold to maturity or if you hold for the long term, then you should be recouping those long-term, the short-term negative mark-to-market losses over the long term, and more than compensated by the distribution yields that you gain as well. So anybody want to comment at all on the asset class balanced portfolios or negative recent returns? Ben hasn't spoken much, so can I put to Ben any comments or thoughts or any sharings you'd like to have as we wrap up?
Yeah, there's a broad range of questions. I guess just on the recent returns and putting some of that in focus, we've had a very long bull run for equities. In fact, it's best described as a golden era for equities. So it is natural to have some sort of pullback, and we all should be aware when investing in markets that that volatility comes hand in hand. But if history is a guide, these market pullbacks do provide opportunities to pick up stocks at better valuations than they were last week. Just looking at certain share markets, there's some that are down high single digits, even double digits over the last couple of months. So while some would view that in a lens of concern, others would view that in terms of a lens of opportunity. So I think that's probably my comment on that. I think also in terms of high dividend stocks, they have fared much better in the recent last few months, particularly since looking globally since the end of November. High dividend stocks have outperformed other styles, including growth investing. There's still a few growth stocks that have done exceptionally well despite style headwinds, but dividend investing has fared relatively well.
Wonderful. Thank you, Ben. Anybody else? Nope. If that's the case, we're actually well over time. And thank you for joining us. If you some of the questions specific to Endowus, if you can reach out to our client advisors, we'd be happy to respond on specific questions about Endowus. Today was much more focused on the fund management partners that we have who joined us on our call today. So I would love to thank everybody who's joined us for this session. I'd like to thank ladies first, Lucy, who's dialing in from London, I believe, right? And Alex also from London. Lisa is here in Singapore with us. Ben is a few hours ahead of us. So thank you so much for joining us. It's been a wonderful session. Just to remind you all that there is a recording. This is the recording for the fixed income investing session that was held last week with 4 other fund management partners that we had. Today's session will also be available, so please check out the YouTube channel that Endowus has, where a lot of wonderful content exists to help you succeed in your investing journey. Thank you once again for joining us and have a wonderful evening.